There's understandable, widespread excitement about artificial intelligence. Also understandable are the parallels some are drawing with the early 2000s tech bubble, implying this boom will soon bust. But this is not the late 90s, and the early days of AI look much different than the early days of the internet. A very notable difference is the majority of AI investment today is coming from large tech firms that have seen years of strong profitability growth and have really robust balance sheets. In other words, they can absolutely afford to spend as much as they are. This is very different than the startup firms without any revenue, leveraging significant debt, or issuing stocks in the dot-com boom, hoping investors would bite just because they had a dot-com in their name. The left chart here illustrates this difference, showing the price to earnings or PE ratio for the tech-heavy NASDAQ. During the 1990s dot-com era, investors bid up stock prices to stratospheric levels relative to underlying earnings. By comparison, today's levels are still well below that exuberant peak. Yes, valuations are high, but they don't seem unjustified in our view. Investors are paying a premium for future earnings that are likely to materialize. For example, hyperscalers have been generating high return on capital employed, between 21 to 44%, even with the increase in business investment into AI infrastructure. Bubbles also tend to feature a ton of new stock supply entering the market. But over the last year, stock supply has been decreasing mildly in the US and quickly in Europe. We are seeing signs that this downward trend is turning around, but not even close to the levels we typically see during massive equity bubbles. And the fact that people are so worried about this being a bubble is part of what makes it unlikely to happen. The risk of a market downturn is highest when people are euphoric, and right now there's still plenty of fear over this topic. That is a good thing.